All right, we're kicking off with an amazing session. First of all, it's a real honor to have Howard, who needs no introduction, and also John, who may be less familiar, but is a Morgan Stanley alum like me, but now is the Vice Chairman. John happens to be in Hong Kong. He's actually based in London, right? And so he's traveling through. We managed to get him, and thank you, PIMCO, for the support, and Howard for gracing us with your presence here today. I'm going to kick off with you, Howard. So in our recent conversation, she shared about an interesting story. So Howard had a bet with a pretty prominent economist that will remain unnamed about when the Fed will cut rates this year. And so this was back in November last year. Obviously, we know who won the bet, otherwise I wouldn't be saying it. Howard won the bet because Howard thought that the cut may not happen as quickly as most people expect, whereas the economist was much more mainstream in his view, thinking that the Fed will cut very quickly. So maybe to you, Howard, why did you think that? What were the bases and the foundations? Because it's such a topical subject, and obviously Powell talked about staying higher for longer. So we'd love to hear your thoughts about the Fed and the thoughts behind your views.
Okay. Thank you very much, Sam. Thanks for having me. And now I have learned not to make forecasts in public, so that's really a bet among friends for fun, yes. for a lunch. So I won't, probably I have run a decent lunch. Yeah. That's early part of November. When my friend said that the first rate hike would be in the Q1, at most Q2, so I thought probably it would be later. So very spontaneously, we entered into a bet over lunch. Maybe I was trying to find a reason to take him to lunch. But I think the motto of this story is we entered into that bet in early November. That's before the Fed pivot. After November, I almost conceded. But the rest is history now. I think the future suggests that probably I would be have a better odds to winning. I'm telling this story just to say that financial markets is really pretty unpredictable. Yeah. And especially when we talk about short-term variation, and even the market is almost 100% sure. If you look at the Fed Fund future implied probabilities, almost 100% sure that the first rate cut would be in Q1 or Q2. But it turns out that things could move pretty quickly. And true to what they said, the Fed say that this is data dependent, so new data comes in, new decisions. Yeah. So the motto of the story is no matter how good one is and how much experience you have, one can be humbled by market performance, especially in the short run. And perhaps as investor, especially like institutional investors like us, we are not as quick as individuals to capture short-term market fluctuation. The biggest decision is on discipline, asset allocation, and then sometimes staying power is more important than being very smart in the short run. So I guess this is something that a story that I would like to tell for this reason.
Absolutely, thank you for sharing that, and it's completely in line with Endowus's investment philosophy. It's ironic that this year things are playing out very similar to last year, right? Because last year at the beginning of the year, people were talking about, hey, the Fed's going to start cutting rates, we should go into fixed income, and all that prognosis that ended up not being correct. And this year, the same thing. It's almost deja vu. And John, obviously, PIMCO is the single largest fixed income investor globally. Maybe you can share, your thoughts about how and why inflation is so sticky. And it could be PIMCO's official view or your own views about, the prognosis of the macro economy going forward. Yeah.
Sam, thank you for having me. Well, I think we have 30 minutes and we have about 4 hours of material. So I think we're going to have to manage that quite carefully. The U.S. economy remains very robust. We talk about inflation being sticky. I think I would take that a step further and say that the fiscal stimulus is sticky. The impact of the fiscal stimulus is robust. It's continuing to have a strong residual effect on the entire economy. In addition, as the rates have gone up, remember, the consumer hasn't really been a victim of rates. The consumer has been a beneficiary of rates because in many cases, their deposits have yielded more. They've taken their money out of the regional banks and put them in mutual funds and other things that have yielded higher. And most of the population remains on a 30-year fixed rate mortgage, which is probably costing them somewhere between 1% and 2%. So they're doing exceptionally well. You can't ignore geopolitics in this, and it's fair to say that the United States is not really heavily impacted too much by what's going on in Europe with respect to the Ukraine. The slowdown in the Chinese economy, while still a large economy, has not really exported deflation yet to the United States. And to a certain extent, the resilience of the US economy remains. And we don't really see that changing in the short term. We see inflation this year staying between 3 and 3.25%, 3.5%. And we see the US economy continuing to be very robust and strong. There's a lot of capital, as you know, going into areas such as artificial intelligence and all the affiliate industries of artificial intelligence. So I think we have to keep all that in mind. In terms of this whole debate about productivity, people say, well, is productivity enhancing the performance of the US economy? It's not yet kicking in from artificial intelligence. That's more capital flows. There is some productivity benefits to GDP because of a supply-side impact of immigration. And that does create probably a 0.5% to 1% impact on the positive side to gross domestic product.
Great.
So to a certain extent, and this is why the world right now is having a hard time, because there is this big divergence between the US economy and its growth and its stability and the fact that all the pundits are out of a job because they've been wrong now. People calling a recession for the last 18 months, no one wants them on Bloomberg anymore because they don't have anything to say. So there is an element here where the strength of the economy is now appreciated more and more because, to a certain extent, it's a fiscal dominant or fiscal-led strong economy.
Okay, great. Thanks for that. I'm going to stay with you, John, and stay with the US. This is a massive election year for the whole world. There's 60 elections going on this year, representing over 2 billion people voting this year. The most highly anticipated and impossible to predict seems to be the US presidential election. So do you have any personal thoughts about the implications and outcomes of a Biden or a Trump win?
You know, when we talk about risk factors from an investor point of view, we sort of say there are 5 big risk factors in the world right now. There's what's happening in the Mideast, what's happening in the Ukraine, what's happening with the future of artificial intelligence, what's happening with the relationship in Asia with the evolution of the Chinese economy. And lastly, there's this question mark around this crucible, what's going to happen in the US election. We know both the personalities. We know Biden very well. We know Trump very well. And I think you all probably know and you've read, it's well publicized, that 70% of the voting population would prefer 2 other candidates.
Neither. Yeah.
They would prefer a different choice. They're hoping to press the refresh button, but there's no refresh option at this point. So we're looking at an election which is 6-7 months off. We're looking at an election that could well be one of the closest elections in history. If it were to take place today, it would be 50-50, really driven by 6 or 7 states, which are more what we call purple states. There are blue states, which support the Democrats and Biden. There are red states, which would support the Republicans and Trump. But there are 6 or 7 states that are very much on the margin. I think from all of your point of view, from an investor point of view, there may not be that much difference with respect to how these two people manage their economic policies. Both are going to be fiscally generous, is a good word. Both are going to continue to invest heavily in defense, which is another element of economic stimulus. Both are going to continue to play the domestic card of trying to be challenging towards tariffs with respect to China. Both are going to be wary of the dominance of foreigners to, for example, electric vehicles, solar panels, lithium batteries. So both of them, to a certain extent, aren't going to be that different. From a foreign policy point of view, some countries prefer Trump from a foreign policy point of view because he's considered to be more disruptive and uncertain. Other people prefer Biden because they know the playbook. But it's an interesting period in history, and I think it's the most interesting geopolitical risk assessment that I ask, and we now have people asking questions about portfolio allocation and how it should be reconsidered because we're active fixed income managers as a result of the outcome of the election. And I think this is the last thing I'd say. I'm sorry to take so much time. You really have to look at this in 3 time blocks between now and the election, which is November 5th, between the election and the inauguration, which could actually be a very volatile period in markets, because depending on who wins, there'll be a reaction by the people who lose, and there'll be a lot of market uncertainty and ambivalence during that period of November 5th and January 20th, and then there'll be the period incorporating the policy of the new leadership after the 20th. And I guess the last point is, we think there's only about a 60% probability that you'll have a divided government. And by that I mean either the House or the Senate are Republican or Democrat. The likelihood of where all 3 will be in the same party is probably no more than about 20%.
Great, thank you so much. And we're going to bring it closer to home now into Howard. Obviously, apart from the US, what's on everybody's mind? China, the outlook for the economy. People are worried about the stock market performance, and we just ascertained predicting the future of the stock market is a futile effort, so I won't ask you what the stock market is going to do, but I've said many times China is facing a lot of structural headwinds. There's been decades of misallocation of capital into low return and unproductive sectors, such as real estate, state-run enterprises, and it will take time to restructure, so it's not something that's going to be fixed overnight, but would really love to hear your thoughts on this as well and where you think China is headed.
Well, no doubt mainland China has been facing some economic issues in the last couple of years, most obviously the property sector and slowing consumption and some other issues. But there are also some bright spots, overnight release figures, GDP's really beating expectation, and it's not super bullish, but still, I guess people would take it that stabilization is in sight, and it perhaps would still take quite a bit of time for some excesses to be removed or digested. But I would say that in terms of an investment market, Some other investors have said that it's too simplistic to say that whether it's a good market or a bad market.
Yeah.
And there are good investment in bad markets, there are bad investment in good markets.
Absolutely.
And now if you look at it from a more macro perspective and step back a little bit, China is the second biggest economy in the world, and by a big margin as compared to the third. And from an asset allocation point of view, as I mentioned, asset allocation is really the number one thing that one should consider. It doesn't make sense for a serious investor and investors with a long-term view not to have exposure in China. Now, this is really borne out by fact as well. Despite all the doomsayings about investment in mainland China, you look at the figures in like Bond Connect in fixed income in mainland China. Now, granted, in 2022, there was some outflow of some 200 billion from the Bond Connect into China. So it's partly also has to do with the changing rate differential between the US and mainland as well. But if you look at subsequent figures in 2023, there were inflows of 400 billion. And just for the first quarter this year, there was further inflow of 250 billion. So investors are voting by their feet in the sense that you still see opportunities in mainland of China. And if you look at the performance of certain fixed income instruments, you take Chinese CGB as compared to US Treasury. If you are a US dollar investor, despite the depreciation of renminbi last year, you invest in bonds in mainland China and US Treasury, given the yield movement, you actually have positive return in US dollar term by investing in mainland bond last year, as compared to negative return in US Treasury. So now, it's not about good market, bad market, and it's about picking investment. Even in US equities market, everybody thought it's super positive market, but if you do not pick the Magnificent Seven, and probably you are pretty flat, and if not down. And so I think it's too simplistic to just look at it. And from a long-term and asset allocation point of view, I believe Chinese asset is something that one would have to look at. I don't talk about timing. Is everybody's guess about best timing, but long-term basis, I'm still quite positive.
Great. And John, I'm surprised at how knowledgeable you are in China. You're a friend of China. Would love to hear maybe your thoughts on China or PIMCO's official view. If there's any controversial views that you have, that would be even better.
Well, I take the... I've spent a lot of time in China in my last... I was going to say in my previous lives, but probably in this life. And I think people talk about American exceptionalism, and I would take the view that both countries and both economies are exceptional. And China is exceptional because of its history, because of its civilization, and because of the magnitude of what it's actually accomplished in the last 40 years, which is extraordinary, and being the second largest economy in the world. And I think we actually think to take a page out of what Howard was saying, you can't generalize about China. And I think there's a lot of people who don't understand the fact that the Chinese consumer is a cash-oriented investor who doesn't like debt. The Chinese-oriented investor is someone who's very prudent and is very conservative. And right now, there's a very high savings rate in China, concerned about a lot of reasons, but the savings rate, and therefore the retail financial market there, is developing. And we actually are quite encouraged by the evolution of capital markets in mainland China. I think what the foreign press on China doesn't understand is that the amount of debt is not held at the government level, it's held at the local level, and it's in local currency, and it's different than what people think. So there's an investor communication issue there, which has led a lot of people to be much more cautious. But obviously, we look at real estate credit and some other areas in a very granular way, and as Howard said, you've got to look at everything in a very big economy case by case. There's a lot of people who've done very well in the green space, in green industries within China. So again, one has to be very careful. We're positive about China. We're positive long term. But I think we also have to be cautious about the short term until the government looks at some further stimulus to rectify some of its current challenges.
Yeah.
So we have a very measured view in the short term, and we have a positive view in the long term.
Yeah, wonderful. And we have our separate equities and fixed income panels coming up later with experts from our fund manager partners, so please stay for that. Going back to you, Howard, Endowus has now entered the Hong Kong market. Do you know what the single most commonly asked question we get? It's actually, how is Hong Kong, going to compete with Singapore? And, is Hong Kong still got a chance? Is Hong Kong better than Singapore? This kind of question of comparing Hong Kong and Singapore as a wealth market. And we always answer with the fact that, there's a reason why we've entered the Hong Kong market. We really do believe in the future of Hong Kong as a competitive wealth management hub for the region, especially for North Asia. China, Hong Kong, Japan, Korea, Taiwan are massive wealth markets. But the local market itself is tremendous. $4 trillion of wealth and growing. Pension is a growing piece of that as well. And we have a massive wealth transfer that's happening across the whole region, and Hong Kong's no different. And then the final piece is obviously the Greater Bay Area Wealth Connect. You mentioned the Bond Connect, but there is going to be growing interconnectedness between the Greater Bay Area and China more generally, and Hong Kong will play a very important part in the development of the wealth management industry. So we'd love to hear your thoughts about these questions that keep arising, and then what are the crucial elements that will make Hong Kong a leader in the region for the wealth space, and roping in the fintech angle as well would be great because you're in charge of fintech.
Right. Well, thank you very much. I think a comparison between Hong Kong and Singapore is a question that I've been answering for my almost 40 years of my career life, but
now they're redirecting it to us.
No, I think that, of course, we all look at different places and try to sort of absorb good things, try to avoid the pitfalls that we have seen. I think there's no single benchmark to say that which is better, which is not better. And then if I were you for a business, I'm sure you're doing this, it's maybe too simplistic to really take a business, even if it's a successful business, and like a cookie cutter and put it to another city and assume that you would be equally successful, because each city might be good at different things. You might have different clientele. You might have preferences of different clients. Like American investors, the behavior might be very different as compared to Asian investors. Likewise, Singapore, the hinterland is more maybe like the ASEAN countries, Southeast Asia, but Hong Kong, you might capture a lot more the GBA area. But the important thing is Hong Kong in itself provides an extremely fertile ground for companies, asset management companies, in the sense that, of course, Hong Kong in itself is a pretty, in a way, a wealthy city, and a lot of demand for investment, even by the own 7 million population. And if you look at the Greater Bay Area, and we are trying to sort of enlarge the catchment area, the Greater Bay Area, through different schemes like the Wealth Management Connect. And mind you, for those who are not familiar, the Greater Bay Area is an area with close to 90 million of population, and it's not a poor area. The per capita GDP is some $22,000. The total GDP is as big as a G20 country. So now imagine that if we can sort of capture this opportunity, and then the evolving middle class and the increasing demand, like what John just said, that a lot of them want to turn saving in terms of deposit into investment product and then supporting their retirement. This is a huge opportunity a lot of companies would like to capture. The Wealth Management Connect, we announced some enhancement in January that would facilitate more companies to access to more people, and then giving more flexibility to really provide the services. The important thing is this is Wealth Management Connect 2.0. And some people still say that, oh, this is not good enough. Now, this is 2.0. There could be 3.0. There could be 4.0. The important thing is, like a lot of policies in mainland, including the Connect schemes, we want to do it in a gradual basis, but in an incremental basis as well. So when the demand is there, when things are operating smoothly, we certainly would continue to discuss with mainland authorities to open up more opportunities, both for the investors across the border and the asset management companies here.
Yeah, it took many years for the Stock Connect to really evolve northbound, southbound into a fully fungible market,
exactly.
and I think that will happen in the wealth management. We're excited about that and participating in it. There is a question from the audience that I'm going to just weave in the interest of time. The other flip side of the Fed staying higher for longer is obviously the dollar strength, which has been phenomenal, which impacts multiple countries across the region. But it has special, impact on the Hong Kong dollar because it's a peg currency. How do you see? The question specifically is asking, is it time for the Hong Kong dollar to depeg and track the RMB in the next few years? Which is a very sensational suggestion. But yeah, maybe just generally you can respond, not necessarily to specifically.
Howard
to
can
the
answer
peg.
that.
Yeah, Howard will
That's
start.
a question for you, Howard.
I think that's an easy question to answer. So I'll say the same. The question is no. I think the current system is the best for Hong Kong, and we have gone through different economic cycle, different ups and downs of US dollar strength, and it has proven to serve Hong Kong well given the unique circumstances of Hong Kong. So we have no plan. We see no need to make any change.
Absolutely. Yeah, agree. John, I'm going to ask I wasn't going to ask the question, but I'm going to ask you AI, because I know you have some thoughts about that and the impact of that in the space. You have 1 minute, sorry, to answer the question. Okay, I'll give you 2. Go ahead.
For those of you who understand American baseball, we're in the second inning of a 9-inning baseball game. Artificial intelligence is something PIMCO has embraced in terms of its portfolio management. We spend a lot of time with clients taking them through how we manage portfolios using a whole range of research, quantitative, qualitative, judgmental type analysis. AI is unquestionably, as long as it's a vocabulary and a tool that's used by everyone, it will elevate the quality of the information, it'll elevate the quality of the analysis, and most importantly, the judgment and the conclusion. So we've been very positive on it. We've embraced it for the last really almost 2 to 3 years, and all of us have our own individual modules where we work with AI. And it's particularly relevant in this environment where, from an investor perspective, you really want to be prudent with some level of diversification and being prudent looking at what's happening globally and what's really happened in the last 3 years in terms of how the whole market has changed and fiscal largesse continues, and the fixed income market has really become an anchor for portfolios and a renaissance for portfolios, which hadn't been the case prior to that. And I was interested to see your reference to private markets. I'm conscious of the fact that private credit or private fixed income, it's a relatively new asset class. It's only been a differentiated asset class for the last 5 years, and it's one that artificial intelligence is coming to grips with as well.
Fantastic. Howard, any final thoughts and voice about embracing AI or technology to make Hong Kong more competitive?
Well, embracing AI is, I think, every company, as every organization has to do likewise. In the HKMA, we have to do. But in the end, I think just like any other technology, the idea of like offering some services on the basis of AI is a novel attraction, maybe a novel idea, some fancy products. But at the end of the day, clients would ask, what problems? What are the problems you are solving? Are you providing better service to me? I guess in your case, are you providing me with superior return, no matter whether you are using AI or using human or using sort of whatever means that you do? So the proof of the pudding is in the eating.
Yes,
AI
absolutely.
is something that we all want to harness, but the result is what's really important.
Yeah, we're excited to say that actually we're the first wealth management firm to embrace GPT technology-based chatbot. We've developed an internal large language model called WealthWise AI to supplement that. And what we believe is that AI is really about two things, the two E's, experience and efficiency. If we can enhance the experience of our clients and also improve the efficiency of our employees and our company, that's where AI, I think, is the most powerful. But with that, we run out of time. Thank you so much, Howard and John, for gracing us.
Thank you so much, Sam, for moderating the discussion, and to Howard and John. Thank you very much.